The offices of Bernard Lawrence Madoff Investment Securities had never felt so quiet. For decades, money had flowed through this firm like clockwork. Every month, investors expected the exact same thing: steady profits, reassuring statements, and the comforting belief that Bernard Madoff could do what no one else on Wall Street could. But behind the polished glass doors and the multi-billion-dollar reputation, something had fundamentally changed. The money was gone. Not because of a bad investment, and not because the stock market had crashed, because it had never really been there. After years of fooling billionaires, celebrities, charities, and some of the world's most respected financial institutions, Bernard Madoff was finally out of time. His investors wanted nearly $7 billion back, but he had only a microscopic fraction of that left in the bank. The illusion that had survived for decades was about to collapse in less than 24 hours. What happened next would expose the largest Ponzi scheme in modern history, erase billions of dollars in paper wealth, and permanently shatter how Wall Street looked at trust. But here's the question that still confounds investigators today. Bernard Madoff wasn't an unknown con artist operating from a dark basement. He wasn't hiding in a tax haven, and he wasn't pretending to be a banker. He was Wall Street. He had helped pioneer electronic trading. He served as the chairman of NASDAQ. Some of America's biggest banks trusted him with their lifeblood, and regulators investigated him multiple times, only to walk away convinced everything was fine. So how does someone hiding the biggest financial fraud in history become one of the most respected men in American finance? To answer that, we have to go back nearly 50 years, long before the headlines, and long before the FBI knocked on his apartment door. We have to look at a young stockbroker in New York who had no idea he was about to build the greatest financial illusion the world had ever seen. When people think about financial criminals, they usually picture someone reckless, someone flashy, someone constantly one step away from getting caught. Bernard Madoff was none of those things. If you had walked into his office in the 1980s or 1990s, nothing about him would have seemed extraordinary. He wasn't loud, he didn't chase cameras, and he rarely gave interviews. Even his workspace reflected his personality: clean, quiet, and almost aggressively boring. And maybe that was his greatest disguise. Because trust rarely comes from excitement. Trust comes from familiarity. Long before his name became synonymous with fraud, Madoff had earned genuine, hard-won respect. He founded his investment firm in 1960 with just a few $1,000s saved from working as a lifeguard and installing sprinkler systems. Unlike the grifters who would later try to imitate him, Madoff actually understood the mechanics of the market. His core brokerage business was entirely legitimate. In fact, it was highly successful, becoming one of the true pioneers of electronic market making at a time when most stock trades were still handled manually on noisy trading floors. As technology transformed Wall Street, Madoff wasn't just keeping up with the future. He was helping build it. That impeccable reputation opened doors that money couldn't buy. By the early 1990s, he had risen to become the chairman of NASDAQ, one of the most influential positions in global finance. To investors, that title meant everything. If anyone understood the inner workings of the stock market, it was Bernard Madoff. And that's what made him so dangerous. Because the greatest lies are always built on a foundation of truth. His real business was profitable. His reputation was real. His influence was real, which made people blindly believe that everything else he touched must be real too. Soon, wealthy families started talking about him in private circles. Not because he advertised, but because someone they trusted knew someone who invested with Bernie. And if there was one thing Madoff understood better than stocks, it was human psychology. Most investment firms spend millions of dollars trying to convince clients to hand over their cash. Madoff did the exact opposite. He made people feel lucky just to get a meeting. There were stories of elite investors waiting months, sometimes years, just hoping to be accepted. Some were politely turned away. Others were told the fund was completely closed to new clients. It sounded irrational. Why reject people who want to give you money? Because exclusivity changes everything. The less available his fund appeared, the more valuable it seemed. Human psychology has a strange habit of confusing rarity with quality. The harder something is to obtain, the more we instinctively assume it's worth having. Luxury brands understand it. Exclusive country clubs understand it. Bernard Madoff weaponized it. Before long, his fund became far more than an investment. It became a status symbol. If you were invested with Bernie, you weren't just making money. You were part of an untouchable circle that everyone else was begging to join. That reputation spread quietly through elite golf courses, private banks, family offices, and close-knit communities where trust traveled much faster than facts. Eventually, Madoff stopped needing to find investors. The investors found him. Some of the world's largest feeder funds began collecting money from thousands of everyday clients, pooling billions of dollars together and placing it directly into Madoff's hands. Often, those everyday clients didn't even know their money had reached him. They simply believed experienced financial professionals had already done the hard work of vetting the investments. After all, why would multiple global banks, elite auditors, and federal regulators all trust the same man if there was something wrong? It seemed impossible, and that's exactly why nobody looked closer. Every respected institution merely reinforced the credibility of the next. Banks trusted him because regulators hadn't stopped him. Regulators trusted him because major banks invested with him. Investors trusted him because everyone else already did. It became a perfect circle, not of evidence, but of assumption. For years, Bernard Madoff reported something almost magical. Month after month, his clients made money. When the markets crashed, they still made money. When the markets soared, they made steady gains again. The returns weren't outrageous, and that was the absolute genius of the scam. If he had promised to double everyone's money overnight, the alarms would have sounded immediately. Instead, he promised something far more seductive to the wealthy: consistency. Just enough profit to seem impressive, but never enough to seem impossible. At least, not to most people. There was, however, one man who looked at those flat, consistent lines on the chart and knew something was deeply wrong. Not because he had inside information, and not because he knew Bernard Madoff personally, but because mathematics does not care about reputation. In 1999, a brilliant financial analyst in Boston named Harry Markopolos was asked to do something simple. A client wanted to know if Markopolos' firm could replicate returns similar to Bernard Madoff's. At first, Markopolos assumed the answer would be yes. Surely there had to be a logical, mathematical strategy behind those remarkably consistent gains. So he sat down to reverse engineer Madoff's performance. Hours turned into days. Days turned into weeks. And the more he calculated, the less sense it made. According to Madoff, he was using a sophisticated options trading strategy known as a split strike conversion. On paper, it sounded brilliant. In reality, the math violently collided with physics. Markopolos checked historical market data, compared trading volumes, and analyzed option prices over and over again. The conclusion never shifted. There simply weren't enough options being traded in the entire American market for Bernard Madoff to actually be executing the trades he claimed. It wasn't just difficult, it was mathematically impossible. Either Bernard Madoff had somehow unlocked a secret law of economics, or the trades never happened at all. There was no third option. Markopolos decided to warn the very agency responsible for protecting investors, the U.S. Securities and Exchange Commission. He didn't send a vague email or make anonymous accusations. He prepared detailed, airtight reports. He laid out the mathematics, proved why the returns were mathematically fabricated, and even listed the exact questions investigators needed to ask to blow the case wide open. To Markopolos, it seemed obvious. The puzzle was solved. This would be over within days. Instead, nothing happened. The SEC reviewed the information, opened brief inquiries, closed them, returned years later, and left again. Over nearly a decade, the SEC had 5 separate, distinct opportunities to uncover the largest fraud in history, and every single one slipped away. How? Part of the answer was Madoff himself. He never panicked when regulators visited. He welcomed them into his office with total confidence, answered questions calmly, and spoke the elite language of Wall Street fluently. To young, inexperienced investigators, he looked exactly like the financial titan everyone already believed he was. But there was a darker problem. The SEC wasn't investigating a stranger, they were investigating a financial celebrity. Human beings are deeply vulnerable to authority and reputation. Even regulators fall into psychological shortcuts, assuming someone must be legitimate simply because society has deemed them so. That single assumption became one of the most expensive mistakes in financial history. Because behind the polished image, the empire was astonishingly fragile. While Madoff's legitimate brokerage business hummed smoothly on the upper floors, down on the 17th floor, a small group of trusted employees quietly produced a manual illusion. There were no secret algorithms, no revolutionary models. Trades were completely invented after the market had already closed, systematically backdated to match whatever performance investors expected to see. Old computer systems spit out fake account statements that looked authentic enough to satisfy thousands of clients. The billions of dollars appearing on those statements existed only as ink on paper. Meanwhile, the machine fed itself. Every successful withdrawal became free advertising. Every satisfied client recruited another. As long as new money kept arriving to pay out the old investors, the illusion could survive. And for decades, it did. But every Ponzi scheme shares the exact same fatal flaw. It doesn't collapse when people stop believing. It collapses when too many people ask for their money back at the exact same time. In September 2008, Wall Street began to unravel. One by one, financial giants started falling. Banks stopped trusting each other, credit markets froze, and panic gripped the globe. Investors who had spent years believing the market would always recover suddenly wanted one thing: their cash. For Bernard Madoff, this wasn't just a market downer. It was a death sentence. Almost overnight, redemption requests began flooding his office. Not millions, billions. Nearly $7 billion in frantic demands arrived at the worst possible moment. And the bank account was running dry. On the evening of December 10, 2008, Madoff gathered his two sons, Mark and Andrew, inside his Manhattan apartment. Both sons had spent their entire careers working on the legitimate, trading side of the family business. Neither had any idea that the investment advisory branch on the 17th floor was a multi-billion-dollar ghost. Madoff looked at his sons and finally uttered the words that would destroy their family forever. The business was all one big lie. Decades of prestige, success, and trust evaporated in a single sentence. His sons didn't argue, and they didn't help him plot an escape. Instead, they walked out, contacted their lawyers, and notified federal authorities the very next morning. On December 11, 2008, FBI agents arrived at Bernard Madoff's door. When an investigator asked him point-blank if there was an innocent explanation, Madoff paused, looked at him, and said, "There is no innocent explanation. There was no dramatic chase, no attempt to flee, and no resistance." The man who had fooled the world surrendered quietly. As investigators dug into the wreckage, the true, agonizing scale of the devastation came to light. Madoff hadn't just swindled greedy billionaires and faceless institutional banks. He had stolen the lifework of everyday people. Retirees discovered their entire life savings had vanished. Civil servants, teachers, and farmers lost pensions built over generations. Universities, hospitals, and charities suddenly found themselves on the brink of ruin. The Elie Wiesel Foundation for Humanity, built by a Holocaust survivor to do good in the world, lost nearly everything it had. Madoff didn't care about the source of the money. He consumed everything. In March 2009, Bernard Madoff pleaded guilty to 11 felony charges and received the maximum sentence: 150 years in federal prison. But a prison sentence couldn't fix the damage. Some investors were forced back into labor late into their 70s. Families lost their homes. Some never recovered emotionally, and for a tragic few, the consequences became fatal. 2 years to the day after his father's arrest, haunted by the scandal and the relentless public scrutiny, Madoff's son Mark took his own life. The ripples of the lie kept destroying things long after the handcuffs were put on. Yet, the story didn't end in a prison cell. A court-appointed trustee named Irving Picard faced the impossible task of recovering money that had technically never existed. Picard launched an incredibly aggressive strategy. He pursued the banks that looked the other way, the feeder funds that ignored the red flags, and even initiated controversial clawback lawsuits against investors who had unknowingly withdrawn more money than they originally put in. It was legally and morally messy. Some argued it punished the victims twice. Others argued it was the only fair way to distribute what little money was left. But against all odds, the recovery effort became the most successful in the history of financial fraud, clawing back over $14 billion and giving thousands of victims at least a piece of their lives back. Looking back, It is tempting to view Bernard Madoff as an unprecedented criminal mastermind, but that explanation misses the point entirely. His greatest weapon was never finance, mathematics, or technology. It was social proof. He understood that human beings rarely question someone whose reputation has already been verified by everyone else. Each person's blind confidence became the evidence for the next person's investment, until nobody remembered to ask the only question that actually mattered. Can anyone actually prove this is real? The Madoff scandal remains a stark, haunting lesson about human nature.